Hey, hello, and good afternoon. My name is Marty Karaman. I'm the partner in charge of our tax credits incentives advisory group and a member of our strategic tax advisory group as well. This is the fourth of four sessions as part of our strategic tax advisory virtual conference. We kicked it off on Tuesday with a discussion on our overall process to do a strategic tax review. Talked a little bit about some of the credits and incentives issues as we look at a variety of companies. We then talked in another session about site selection opportunities. Earlier today, we had a session on some of the opportunities and planning that goes around transactions. And we have saved maybe the best for last, we'll see. But we are talking today during this session on what's really a developing market for the purchase and sale of clean energy credits, those that were created during the Inflation Reduction Act. All right, so I'm going to go through the agenda, then I'm going to introduce my co-speakers here. We'll talk a bit about the Inflation Reduction Act, just overview a little bit, passed back in 2022, kicked in 2023. We will then go through some of the investment tax credits and production tax credits that are available, really all of them. And then I think the bulk of what we're going to talk about is the new ability to sell tax credits and purchase tax credits for those that either want to reduce their tax liability on the purchase side, and those that may not have a tax liability may wish to sell them. This is clearly one of the largest and most interesting developments that's happened in federal tax law while I've been practicing for the last 25 years. We'll talk a bit about some of the credit transfer process and how that works too. And then at the end, I think it's important to sort of talk about some of the accounting issues around tax credits and how you account for them after purchase. So let's move on. This is our first polling question, and then I'll do the introduction. So how did you hear about this webinar? A, from a Cherry Becker tax advisor. B, from an email from Cherry Becker. C, a friend or colleague. D, Cherry Becker alum. Or E, social media post. We'll wait here, but I think now may be a good time to begin some of the introductions. So let me hand it over just to introduce himself. My partner at the firm, Will Billups. And then after that, we will have David Moamani, who's a manager in our group focused on this area. So Will, take it away.
Marty, good afternoon, everybody. Thank you for joining us today. I'm a tax partner based out of the Nashville office. I lead the firm's income tax provision practice, and I work hand in hand with strategic tax in a lot of ways. So as we're doing tax planning, as we're doing acquisitions, divestitures, as we're planning for these tax credits, we got to report this in our financial statements. So I appreciate the introduction, Marty, and I'll take us through some of these learning lessons and learning objectives later today. We'll kick it over to David to introduce himself.
Yeah, let me just read out the poll for a moment and see how that plays out here. All right, so most people on here got an email. I'm very happy about that, actually. I want to give kudos to my marketing team. Had you seen the logistics that went into getting this thing set up today, you'd be very impressed. Anyway, with that said, David, why don't you introduce yourself, and then we'll get into some of the meat of this thing.
Thanks, Marty, for the introduction. Yeah, I'm a manager in our tax credit and incentive group. I focus on clean energy tax credits, and because of the IRA, these credits are now transferable, which is a great opportunity for a lot of our clients. So we're going to talk through that a bit today.
Wonderful. So Inflation Reduction Act, I'm sure everyone on here probably knows. It was passed back in 2022. It became effective in 2023. We're going to focus on the portion of it that has to do with investment tax credits and production tax credits specific to investments in renewables. And so what you see here is a number of the technologies listed that are credit eligible: solar, wind, geothermal, combined heat and power systems. There's even something with respect to nuclear now, carbon capture, hydrogen as well. It's interesting. Inflation Reduction Act has done what it's done really is put some permanence with respect to how large these incentives and how many there are. Prior to this, there was a sort of a number of different incentives that were kind of phasing down, but beginning in 2023, the Inflation Reduction Act both created more incentives, stabilized these credits that they would exist from 2023 through 2032, and and also added in some additional requirements for purposes of maximizing the credit, specific to whether or not in the installation of the project or the facility you are utilizing or paying a prevailing wage or having an apprenticeship program associated with the labor. Also, there are different credit enhancers for utilization of domestic content, whether it's located in an energy community or a low-income community as well. So why don't we move to the next slide? Okay, so now we're going to talk about investment tax credits and production tax credits and provide an overview. And I think this is where David Mohamani is going to take it over for a little bit and talk through some of the basics here on ITC and PTC.
Yeah, so there's two credits we're talking about, Section 48 and Section 45. The first one being the investment tax credit. This is a credit for an investment in a qualified energy technology. So the base rate is 6%. And then to get to the normal base rate of 30%, you need to meet prevailing wage and apprenticeship. And when I'm saying the base rate, it's 6% or 30% of that investment. So if you buy something that's you buy a $100,000 solar panel, the credit would be $30,000 if you don't need to meet prevailing wage. Prevailing wage is only applicable for projects over 1 megawatt. If you are below 1 megawatt, you automatically qualify for a 30% rate. We'll get into more of that in a little bit later, though. And this kind of just explains kind of what the credit is. So it's a credit against your liability. There is a recapture period of 5 years associated with this credit. So things that would trigger recapture would be transfer of ownership of the asset, and the recapture is phased. And so it starts at 100% if it's recaptured in year 1 and phases down 20% for the first 5 years. This can also be carried back up to 3 years and carry forward 22 years. We kind of already touched on the technologies a bit. And then we'll get to Section 45. So Section 45 is the production tax credit. This is a credit based on the actual electricity produced by one of these qualified energy technologies, such as solar or wind. This credit is calculated on an annual basis for 10 years. So it's a 10-year credit term. So you can be generating credits for that amount of time. Whereas the investment tax credit is something you get in year 1. Typically, when we're talking about transfer, a lot of the activity is in the investment tax credit, just because it's simpler to understand. It's only a 1-year thing. So it's a little bit easier for people to wrap their head around. But the production tax credit is another credit that can be sold now. And this is kind of what I just talked about, where it's a 10-year period for when it's placed in service. The base credit rate is adjusted each year for inflation. One important thing is you cannot claim both the ITC and PTC on the same asset. So if you build a solar farm, you can't get an ITC for it and a PTC. Yep, and here's kind of the eligible technologies. A lot of these were added by the IRA. They included a lot of new technologies, so it's much more expansive than what the previous code sections were. So it spurred a lot of investment and interest in this space just by including these new technologies.
And so, David, I think it's interesting. Where we work is on all sides of many of the transactions. It's everything from identifying and describing the technology and understanding whether it is or is not credit eligible. Sometimes there is a little bit of a gray area, so we'll work in that space. Identification and documentation of the specific costs that go into the credit calculation. Understanding when construction began, that can have some effect on some of the prevailing wage requirements, and understanding really when the project or facility was placed in service. So it's a calculation documentation exercise as well. Beyond that, and what we're going to talk about a lot today is for taxpayers who may not have a tax liability. Say, for example, they put it on their return, it wouldn't do them any immediate good until they later had a tax liability. They, through the operation of a change in the IRA, can actually sell this, but we will work with sellers to, again, do almost like a pre-IRS defense thing, but in this particular case, it's for purposes of allowing a purchaser in order to understand exactly what the amount of the credit is and how well it's documented. At the same time, on the counter side, we are working with a number of taxpayers who have a tax liability and are looking through a variety of credits that may be available in the marketplace, and we're performing due diligence. And to the extent it's well documented, the due diligence is a smaller exercise for us. If it's not, we may have to get into it some more. But all of that goes into some of the credit pricing too. But that's just where we are in this particular space. And let's go to the next slide. Maybe you want to talk about some of this stuff. Yeah.
Yeah. So the base credit rate is 6% for investment tax credit, but it can increase up to 30% if you're meeting prevailing wage and apprenticeship. Again, that is only for projects that are over 1 megawatt that need to reach that prevailing wage and apprenticeship requirement. Otherwise, you're locked into that 30%. But there are some actual bonus credits you can get if the project meets certain domestic content requirements. So components were manufactured here in the United States that go into the asset. You can get an additional 10%. There's also an additional 10% for energy communities. So there's a mapping tool that you can use from the Department of Energy where you can see if where your asset is placed into service falls into one of these energy communities, and then you would get a 10% bonus as well. There is also some low income pieces down here for the 10% and 20%. Those are application based, so it's not given if you meet the requirements that you're going to get it. Typically a little bit trickier, but in theory, you could potentially get up to a 70% credit, but I haven't seen anyone be able to achieve that type of credit rate yet. Okay, so prevailing wage requirements. So this just says that any laborers employed on the construction of this project must be paid a prevailing wage. That wage is determined by the Department of Labor, and it's based on the type of work performed, the location that it was performed in. So you have to go to the Department of Labor's website, and they post what the prevailing wage is for different types of work, whether it's iron work or general construction or general labor. They have different rates, and you need to make sure you're paying that prevailing wage rate so that you can get that 30%. And apprenticeship, so for any project placed in service starting this year, you can get 15% of the total hours to be the total hours worked on a project to be completed by qualified apprentices. But there is a cure or a good faith effort exception. So if you're not able to source apprentices, or you apply for them but you just couldn't get them, it doesn't exclude you from then getting this 30%. You just need to have a document that you at least attempted to hire apprentices.
I noticed in the chat someone asked if these are referred to as kickers. I think they are sometimes. We'll go through some of the other kickers, shall we say, that increase that credit. But yep. Okay, polling question 2. Have you applied for any energy tax credits or incentives? Yes, in the process of applying. No, but you are interested in learning more. We'd be happy to talk to you, or no. All right, now as we move on, I know I'll talk a little bit until the polling changes here, but I think we're going to start to get into some of the meat of this later about what I think most people may be interested in, which is the ability to purchase these credits. Hey, David, during our last presentation we were doing earlier today, someone asked you a question about what if there is no apprenticeship program or you try to get it? Maybe you want to address that a little bit too.
Yeah, so that's when you get that good faith effort exception. You just need to document that you have made an effort to apply for apprentices or reach out to an apprenticeship program, and that you just weren't able to source them. Because for some locations and some contractors, it's not really an option.
Right. We're ready for the next slide yet? There we go. All right, the results are in. Most people haven't applied, but they are interested, or no, they just have not. So hopefully this will be eye-opening in some ways to make you aware of what's out there. And again, everybody at Cherry Becker, specifically the people on this call, are available to help you. All right, so now we're getting to the purchase and sale of tax credits, and I think Dave and Will are going to take this away a bit and walk through here.
Yeah. Okay, so transferability. This is a new feature that was introduced by the IRA, where these credits on the federal level are now available to be sold. So what this means is if you would generate one of these credits and you don't have the tax liability to use the credit, you can actually now sell it. Because prior to this, a lot of the developers who create these types of assets, such as solar, wind, they're not taxable. So they weren't getting any benefit from this credit they were receiving. So now the IRA allows that to be sold so they can receive some benefit, and also a taxpayer can receive some benefit. Some general rules around transferability. Any of the payment must be made in cash. You can also transfer all of a credit or a portion of a credit. So you can, if you have a larger credit, and one person wants to buy $1 million and someone else wants to buy $2 million, that's something that you can do. But once that transfer is made, it cannot be then retransferred. So it's a one-time thing once the credit is transferred. And essentially, the person who purchases the credit will then get the number that's registered with the IRS, which is done by the seller, and place that on their return to then claim the credit. So I think I kind of touched on all of these points already. So I'm going to move on to the next slide.
Yeah, and hey, David, when we were on the phone with a client the other day, the question came up as to whether the transfer of the credit restarted the statute of limitations, and how long maybe some of that recapture risk was out there. It doesn't restart the statute of limitations. The statute of limitations begins with the original taxpayer who placed the project in service on the return on which it was placed. It is then while a purchaser may buy this credit, it is still the original taxpayer who is responsible for making sure it doesn't go into recapture or do something that would cause it to go that way. And so that is part of the due diligence process, where we will work with those taxpayers ready to purchase to vet out and give them a sense of what the risk of recapture may be. That may go into then some of the pricing for this credit as well. But that was an interesting question that somebody asked. I want to make sure that was clarified for everybody on the call today.
And David, I think it's important to note here, as we're talking about transferability, recapture risk, there are marketplaces that are offering insurance policies that will pay directly to the buyer if something were to happen. So there are other pieces related to this to ensure that this transferability is kind of around to stay and that it's a successful program.
And we'll get into more of the nuance of the transaction in a little bit. It's kind of high-level overview now. Okay, so the benefit. So if you are intending to purchase a tax credit, or you do purchase a tax credit, you can then defer your estimated tax payments, because you will have a credit, in theory, at the end of the year that would offset, so that those payments are not due. So you have that cash benefit. The timing of when that cash outlay is decided between the buyer and the seller. So if you can negotiate it to the terms you'd like as a buyer, you can essentially, as close to the date you're filing, when you claim that actual credit, you can defer paying, making the transaction finalized and giving them the cash. And these credits, which is really cool, can be carried back up to 3 years. So you have to eat up your current year tax liability first, but then if you do that, you can then carry back to prior years. So you can, in theory, purchase enough credits for 2024 and then purchase in excess of that, and then carry back and get a refund for your 3 years previously. So we've had a couple clients that have worked through that option, and it's a great savings option for them.
Yeah, and that's a big change from the general.
Yeah, this is really where the benefit comes in. As you're doing your tax planning, obviously cash management is extremely important to a business. Cash management, ETR analysis, making sure that you're maximizing the benefits you can get to lower your ETR on your financial statements. So when you're looking at evaluating whether or not it makes sense to purchase credits, not only are you getting a permanent rate arbitrage, but you can plan this in because of the fact that you're going to include tax credits to offset 100% of your liability on your tax return. You would not actually be making any estimated tax payments. So that would allow you the ability to hold the cash throughout the year and use it in your business operations. In a lot of cases, it's going to be very dependent upon the agreement with the seller. We encourage our clients to start discussions on the purchase of credits early in the process so that they can get those locked down. But the agreement on the actual cash outlay and the payment date can be pushed out. So you can actually have a lot of benefit by agreeing to the purchase of credits early on, but agreeing to closing that on a date that's in the future. So if you plan it properly, you could potentially defer a year or more on your cash payment options for your income tax liability through the settlement of tax credits. So this would give you a significant return on investment beyond the savings alone of purchasing credits on a less than dollar for dollar purchase.
Here's kind of some numerical examples of what this looks like from a financial perspective. So you have your current year tax liability of 5.3 million. You purchase a credit of 7.8. So in that situation, you've bought more credit than you are able to use in this current year. That's when you can then carry it back to your prior year liabilities and reduce that, get a refund for those liabilities where you already had paid. And then here's another example of purchasing tax credits, like the dollar amount savings. So these trade anywhere between 85 to 93 cents on the dollar. There's a variety of factors to go into how the credit's priced, which we'll get into. But let's say you paid 87 cents on a $7.8 million credit. Your permanent savings there would be 1 million. And then you also have the additional benefit of those deferrals of estimated tax payments. So you're looking at a $1.3 million benefit there. Yeah, and this is kind of this is a sell side example. So this is for the developers who we also work with, who don't have the liability to utilize all of their credit. So they will generate this tax credit, and they'll have a remaining credit. Maybe they can only use a portion of it, and the remaining piece. So here we have it listed at 1.4 million. They're not able to utilize, and they want to take that to market to sell. So they can do that then. So they are going to then sell that $1.4 million credit. We had put a 10 to 15% discount on it. I think that we end up with the 12%. It's just doing an average of the two. But that would be cash that they would receive for that credit that they have, which is then excluded from gross income. So that way they're able to utilize the full benefit of the credit that they are generating.
Monetization of this is extremely important for developers as they're trying to increase cash flow to expand the business, to expand operations, to expand their investment. It precludes them from having to go raise additional cash in other methods. So this is really a game changer for both the buy side and the sell side.
Okay, so a couple additional considerations. So can't be actively engaged in the business at generating the credits because of the passive loss rules. You must so individuals, this is really an opportunity for C Corps, is what it comes down to. So closely held C Corps individuals, they're going to have those passive income limitations. So they're typically not generating enough passive income for this to make sense for them. So this is really a C Corp opportunity who doesn't have those certain restrictions. So the IRS put out like a notice a few weeks ago that a lot of individual taxpayers were mistakenly thought they could purchase these credits and did so, and now they just can't utilize them. So you have to be very cognizant of the rules when making these purchases, because it's not a guarantee that you can definitely use them. So that's something we want to be, make sure we're informing clients of. And then
be wary of promoters out there who are trying to market these things to individuals just against on their 1040s. It's already become a little bit of an abuse out there, and so that's why the due diligence is so important from our perspective, to make sure the taxpayer can utilize these purchase credits, that they're not subject to passive activity rules. And so yes, want to make everybody aware of that. That's clearly one of the most important facets of credit transfer.
Yeah, and then how are these transactions occurring? There's marketplaces that have developed. There's a bunch of them, to be honest with you. We're partnered with a few. They kind of all have their own different ways of transacting. So it's kind of figuring out what's the best fit for our clients and what they have is in terms of availability of credits when kind of deciding what marketplace to go through. But we'll get into that a little bit more.
Yeah, go ahead. All right, third polling question. All right, are you aware that you can purchase and sell tax credits? I certainly hope so now, but the answer is yes. I've already bought or sold credits, maybe have heard about it or no, but I am interested in learning more, and I would assume that's why everybody is here today. While we're waiting for the poll to go through. Maybe David and or Will, it might make sense to talk about some of the differences you see between like two of the marketplaces we're working with. One who has, maybe I'm going to say the whole thing here, but I'd like your comments. One has an insurance product already wrapped into it, while the other has some indemnification. The seller will provide some indemnification with respect to potential recapture, but it affects the pricing a little bit differently. So I'm curious what your experience there and looking at the different ways that certain platforms are putting these things together.
Yeah, I mean, so for a platform that has insurance wrapped into it, there's going to be a slight premium on the price of the credit just because that's going to be baked into that price. So to the extent you're looking for a greater arbitrage, it might make sense to not use a platform that has that insurance, which kind of automatically sets a floor at what the price is going to be. A lot of the individual credits that are being sold under $3 million do not have insurance unless the marketplace itself is insured. But what is happening in a lot of these cases is that the seller of these credits are offering guarantees and indemnities to potential buyers to kind of protect them from that recapture risk. So that's kind of another way that people are navigating it. But those are both kind of factors into what goes into the ultimate pricing that you can purchase the credit at.
All right.
Advocate for my clients who are mostly in the C Corp space. I've got a couple of different views on the related marketplaces. Some of the marketplaces that do their own due diligence and provide insurance, they're really looking for a higher premium on the tax credits that they're selling. There's a lot more administrative burden related to what they're doing, as other marketplaces are kind of letting the market develop and letting it go as to whether or not the seller wants to indemnify or if the seller's looking to obtain insurance. It's all going to be based on buyer risk and risk appetite is a little bit of what I'm seeing. When we go to assist clients, we're looking for the best pricing for the lowest risk we can find. If I have a specific client that has a higher risk appetite, we may be able to go after a little bit more aggressively priced credits. There have been, kind of clients all over the board from the lower to the higher end. I would say, in my experience, I think the best sweet spot for minimizing risk with maximizing return has generally been in the 85 cent to 90 cent range of where we've landed. There are obviously highly premium quality credits that may be a little bit over that rate. Those are going to be insured. They're already going to have due diligence. They're going to maybe have hired a firm like ours to come in and provide a full package and suite of information, as well as additional due diligence by another third party. There's all kinds of activities going on to document and qualify these, but there's a broad range out there. And this being so new, this is where we're really relying on David and Marty's team, who've been in this space for a really long time. These are not necessarily new credits. The transferability and the buy side for the buyers is really the new part. So having them here to verify that documentation is in place, it's an absolutely qualified activity that is a no-brainer. Those are things that we can rely on for their expertise and input that really help buyers navigate the marketplace. They're also a client advocate. So when you have Marty's team go actively into the marketplace, they're looking for the best answer for you, which I really like. I'm a big client advocate. I'm always trying to push in favor of my clients, and they do that with me. It's really easy to pair with them and go navigate this new world of transferable energy credits when I have them working with me.
So this kind of details what the transaction looks like. So marketplaces will have these credits eligible or listed, I should say, that can be purchased. So typically, a buyer can be invited into these marketplaces. We can invite our clients into these marketplaces, and they can review the credits and then begin to bid on these credits. Some of our clients like to do that process themselves. Others kind of defer to us in making the bid in their name and then kind of having the preliminary discussions about kind of the deal terms and things like that. So if both parties agree on whatever deal terms they decide between buyer and seller, and they both are comfortable with that, and then we conduct diligence and we don't find any red flags, anything that kind of draws concern on our end from a risk perspective for our clients, and we give them a thumbs up, then they can close that transaction, and the buyer will then get that number from the transfer number and put it on their return, and then the seller of the credit will then receive the cash from the buyer. So that's just kind of how a typical transaction would look in the process.
I got it.
Okay, so given that this is new, there have been challenges we have seen for sure. I think one of the biggest questions we get, especially earlier in the year, I think people are starting less concerned, but the recapture. Because at the end of the day, if you are the purchaser of the credit who claims the credit on their return, you are the one who is on the hook for the recapture. So we mentioned there are some marketplaces that have this insurance policy that would protect you from that. Individual sellers are offering guarantees and indemnities to buyers. So there's things that can kind of lessen that concern, but we want to make sure that all of our clients are educated about the potential risk that exists. We don't view it to be a large one, especially that's why we're going in and doing the diligence, that before you ever outlay any of your cash, we've kind of checked everything that we need to make sure we think this is a good credit. But that's something we have to, educate our clients through.
David, what would be an example of something that would trigger recapture?
Yeah, so typically it's going to be sale of an asset, or let's say, for example, the asset was purchased and the bank, there's a loan and the bank places a lien on the facility, and then they take ownership of that asset. That would then trigger recapture. So those are kind of things that you have to be cognizant of and kind of what could potentially claw back your credit.
And the IRS is aware, right, of whose credit it is due to the fact that it's been pre-registered, correct, in a database.
Yes, it's registered in the pre-registration portal.
Very good.
Noticed as well, related to some challenges, is really the lack of the expertise. If your company is getting ready to go through due diligence, you may not have folks performing the due diligence who have experience with the buy sell side of these credits. So just be aware that that can be a challenge as well. Getting attorneys up to speed. Attorneys may not have dealt with this. They may not have built this into due diligence activities. So that could be another challenge if you're getting ready to enter that. But I have had great experiences with our team helping get some attorneys and some due diligence over the hurdles related to that.
I think this goes through the recapture I was asking you about. Sorry, I jumped ahead with my question here.
It's okay. But yeah, so we kind of just touched on this, but this kind of is more, explained version of what I said earlier about kind of what can trigger recapture, kind of what that looks like. Again, the recapture is on the ITC. The PTC is not the exact same the way the recapture. So that's more of an investment tax credit. But again, a lot of our clients have been more inclined to go after the ITC credits available, just because it is a credit that's generating year one, the amount. So that's another thing. Okay. So like basic due diligence steps that we'll go through is kind of whether this seller of the credit is eligible to be doing so and they're a qualified transfer. Another thing we look at a lot is reviewing the technical specifications of the asset generating this credit. We kind of, review the cost components that go into what they're using for the basis to determine the credit, see if those are all eligible components that should be included with respect to how you calculate the credit. Again, we also, if there's any bonus credits, if they're, claiming they're meeting domestic content, we need to make sure that there's documentation to support the fact that they are meeting the domestic content requirements. Another really important factor is when the asset was actually placed in service. So, get a commissioning letter from the utility company who turned it on, because that is the year in which the credit will be generated, is the year that is placed in service. Then for prevailing wage and apprenticeship requirements, so if a project is over 1 megawatt, we have to review the documentation that, they have properly identified that, yes, they have met prevailing wage. Yes, they can, it's a defensible item that they have to, for the respect to claiming the credit at a 30% rate by meeting those requirements.
Right. Oops, I think I skipped one. Oh, go back. There we go.
I think that's what we just did.
Okay.
Yeah. So this kind of, I talked about this a little bit, kind of what we are doing in the transaction. Again, we talked to a lot of marketplaces. We kind of, have discussions with them, not even on specific clients all the time, but kind of just about general market trends, where things are going, kind of the different opportunities that are available. Because there's a lot of different people in this space right now, with these credits trying to sell. So it's good to kind of have just a general pulse of like what the market looks like, with respect to these credits. As I mentioned earlier, they're kind of all a little unique. The marketplaces, how they operate. So we kind of let our clients know, hey, this is kind of how it would work. It would work with this platform. This is how it would work with a different platform, and whatever they're most comfortable with. If they want that guaranteed insurance policy, understand that that's probably going to give you a lesser arbitrage because the price is probably going to be a little bit higher because there is that insurance wrapped into it. So it's explaining all the different little caveats of how these markets work and kind of what makes the most benefit for them, with also something they're comfortable with. So it's one of the marketplace work is Crux, and this is the one that kind of allows us to invite clients directly into it, and then we can highlight credits and send to them. We can place bids on their behalf for these credits. So it's a nice way for us to kind of hand-hold and guide our clients through this new space, just because you're seeing these credits, but you have no idea if it's good if you're not involved in this clean energy technology or the different requirements, or if the numbers even make sense. So that's kind of what we're here to do.
Yeah, I have to say, I've seen our tax partners become savvy on this, and many, many more are beginning to reach out to their clients. To the extent you're a C corp and you have a tax liability, and you don't have any other type of credits that are reducing it, it's almost like, why wouldn't you at least look at this? It's something that I think every person or every entity that has a tax liability should be considering. And so I encourage anyone who's on this, or anyone they may know, to please reach out to us. We're more than happy to just begin the process to understand what credits may be available. Before we move on, I just want to ask one more question. I keep asking these random questions you guys we didn't prepare for, but maybe this is for David. What are you seeing right now in the marketplace in terms of the availability of credits? Is it starting to go down for the 23s, or going up? What do you think?
Yeah, so 2023 inventory for these credits has become very limited, just because 1015 is kind of right around the corner on us. And given the time it would take to do the due diligence, I mean, you can expedite the diligence, but on average, a deal is going to take like 6 to 8 weeks to have all the diligence fleshed out. So we're getting real close to that timeline for when a C corp will be able to put that on the return. So there's not a ton of inventory for 2023 credits left. There are some, but yeah, it's definitely dwindled in recent months.
And I think in 24, you may see more credits come online than did in 23, because Inflation Reduction Act will have been 1 year older, and more projects may be coming online that qualify, or perhaps it incentivized someone to get into and do a project that would be credit generating. So I would expect we're going to see the availability of credits increase, but also you're not lost if you missed out on and the availability on 23 credits disappeared, because again, you can carry these back 3 years. That's just such a powerful thing. And so if you did get stuck with a tax liability for 23, in 24, you can still go back and buy more. So it's just a very powerful thing for taxpayers.
It is, Marty. In my experience, this is almost a no-brainer if you're a C corporation with a tax liability. In my experience, it's great. Your team is teaming with whoever's developing the estimate for the tax liability, so that we know how much credit we're actually going for in the marketplace. It's important not to overbuy if we don't sit in an excess cash position. And it's going to ensure that all the quality documentation is there. From my experience working with your team, you're initially setting up the call to understand the risk appetite of the buyer and the client. You're wanting to understand what their needs are, what liability they're looking to meet, what their cash position is, so that we can maximize exactly how we're approaching the market. And you may recommend one market over another based on the client profile and risk appetite. So it's been wonderful navigating all of this piece for all of my clients with your team.
Well, it's been wonderful working with you as well. So. All right, a little bit on credit pricing.
Yeah, so I kind of touched on this briefly. So 87 cents, 92 cents on dollar. Some credits are below 87 cents, some credits are above 92 cents, but that's kind of a general range that we're seeing. Some of the factors that go into the credit pricing. So if it's a smaller credit, typically there's going to be a greater discount because for the arbitrage benefit to make sense for a potential buyer on a smaller credit, it would need to be a greater discount. Because you're not going to, if you're buying a $50,000 credit, you're likely not going to want to pay 90 cents on that credit. Another factor that's going to influence pricing is the insurance, which we kind of talked about. So if it is insured, it might bump up the price that a seller is asking for. So that could kind of limit the arbitrage too. Also the type of technology that's generating the credit. So it depends on kind of what the asset is. And kind of the history of the seller, for more established companies who've been in this space for a long time, you can generally see their pricing be a little bit higher. Because I think buyers tend to view that as less risky because they are an established player in the market. Again, the credit type, ITC versus PTC, is going to have an effect on the pricing because the PTC does not include recapture. So generally PTC deals or PTC credits are priced higher. Some of the additional factors, just it's timing, right? So again, 10/15 is right around the corner. So if there's sellers who are really wanting to get rid of their credits, or on the flip side, buyers who are very aggressively trying to purchase these credits to offset their liability, that might influence pricing one way or the other.
And I even see from the chat there are individuals making us aware that they're aware of some credits we may want to take a look at for our clients. So thank you for putting that in there, and we'll make a point of reaching out.
So yeah, just a few updates. We've gotten some regs on PWA. Some of the things that were addressed in there were the wage determinations, the cure payments, and changes to apprenticeship requirements. I won't get too into the details on that, but that's something that needs to be factored in when doing diligence on these credits, if it is a credit that is getting its base rate by satisfying prevailing wage and apprenticeship.
All right. That ends one piece of the discussion just around some of the mechanics and what's going on in the marketplace, et cetera. So I encourage, again, anybody out there who may be interested to reach out to David, me, and myself. We're more than happy to look at it and help you navigate this marketplace. But with that said, there's also some accounting that goes into how you account for these credits after purchase. So Will's going to talk a bit about some of the accounting for income tax credits after purchase. So Will, take it away.
Thank you, David. It's exciting to talk about all these opportunities to save tax dollars and effectively manage our cash and our effective tax rate. So I think it's important to talk about, okay, we're looking at a transaction, but what is that going to do to our financial statements? Are there going to be some extra things that we need to report? How do we account for tax credits? So I think it's good to start back at the basics. So remember that ASC 740 applies to all federal, state, and local taxes that are levied by a government tax authority. Government agencies and authorities have established programs to promote or guide business activities through financial assistance. We should evaluate the substance of the legislation and whether a credit is required to be recovered through taxable income. Credits that are not based on taxable income, or where a credit can be received without any regard to taxable income, would be considered government grants. They would not be included in the scope of your income tax provision or under ASC 740. Credits based on taxable income in the form of an income tax credit should be accounted for in accordance with ASC 740. Government credits that are refundable, that have no regard to taxable income, are generally not within the scope as well. The Inflation Reduction Act, as we've just discussed, created a number of transferable tax credits where an eligible taxpayer can apply the credit toward the liability or transfer the credit or a portion of that credit to an unrelated party. Refundable transferable credits are not subject to ASC 740 because they can be refundable without regard to taxable income. Non-refundable transferable credits can only be used by being included on an income tax return to offset that income tax liability by either one, the originator of the credit, or two, the transferee.
And Will, that's us pretty much here, right? We're talking about
That's
non-refundable.
right. So that's where we're going to fall into, and we're going to get into the detail here in just a minute. I wanted to cover the background so that we knew refundable credits fall outside of the scope of this, and they're going to be included in your regular operations outside of income tax. But, non-refundable transferable credits are going to be exactly what we need to address. US GAAP does not address the accounting for an entity's ability to transfer credits when the entity is generating non-refundable transferable credits, but there are some alternatives that are applied in practice. So the FASB staff has noted that they have a preference of alternative one. In alternative one, the entity will apply ASC 740 for the credit, and when the credit is transferred to the buyer, gain or loss is recognized in income tax expense or benefit in the income statement. So this is going to matter for the producers or the sellers. Alternative two would be the entity will apply ASC 740 for the credit, and when it's transferred, the gain or loss on the transfer is recognized in pre-tax income outside of income tax expense or benefit. Alternative three, the entity is going to apply guidance other than ASC 740 for the credit and realize the economic benefit of the credit without regard to incurring an income tax liability. So it would be above the line, similar to a refundable credit. So the FASB has kind of said, hey guys, we really want to see alternative one. That is generally how we would expect to see it treated from an accounting perspective when we came in as the audit firm, or if we were going to prepare it for a third party, we would generally prepare it under alternative one. Remember that the realizability of income tax credits is important too. We have valuation allowance considerations. So an entity needs to determine the realizability of the tax credit generated and account for it under ASC 740. Future realization is dependent upon the four sources of income, similar to the exact guidance that's been applied for years. The FASB noted under alternatives 1 and 2, the entity could also consider the transfer of the credits in determining the need for a valuation allowance. And what that means is you can create a source of income by planning to sell the credit. Therefore, that credit is realizable on your balance sheet as a deferred tax asset. For the buy side, ASC 74010 2552 requires a tax benefit resulting from the purchase of a future tax benefit from a non-governmental third party seller to be recognized as a deferred credit recorded in earnings as the deferred tax asset is realized. What that means is you're going to credit cash, you're going to debit deferred tax asset, and as that deferred tax asset is realized, you will recognize a benefit in your income tax expense, which is great because it's going to be very evident within your effective tax rate that you're getting a benefit from something. One of the real curveballs that the FASB threw us last year was the issuance of ASU 2023-09. And what this does is it expands income tax disclosures and requires a lot of additional disclosures. This is applicable for public business entities in 2025, and it is applicable for private entities in 2026. It's going to expand the rate reconciliation disclosures required, and it's going to require you to disclose income taxes paid. All of this is going to be by jurisdiction. The FASB specifically included tax credits as a separate category that is going to be required to be disclosed. This is important. ASU 2023-09 is going to give you a roadmap for companies that are effectively managing their cash and their cash tax liability and effectively managing their effective tax rate. You're going to be able to see everything that's disclosure. We're going to walk through a quick example just to kind of give you an idea of the impact of this. So if you had pre-tax book income of $5 million, permanent differences of 3.6, and then these temporary differences, you could arrive at taxable income of around 12.3 million. When you look at the reconciliation of the effective tax rate to the statutory rate, you can see here that income tax credits is a big benefit in this rate. The effective tax rate disclosure would say that, hey, this is really driven from the fact that we have state and local income tax, we have income tax credit benefit, and then we have non-taxable and non-deductible items. Well, what ASU 2023-09 requires is disaggregation of information that exceeds the threshold 5%. So you're going to have to add disclosures like this. You're going to have to include disaggregation of state income taxes. You're going to have to show the income taxes at the state statutory rates, state non-deductible permanent differences. You're going to have to expand the tax credits. So not only are you going to have to say, oh, wait a minute, now I have to show what R&D credit I created, but also I need to show the benefit for the deferred charge for the credits that I purchased. So if it meets a 5% threshold, you have to get further in depth and specifically discuss these items or disclose these items within your financial statements. This is going to give a big roadmap to everybody reading the financial statements as to what's really driving that effective tax rate. Now let's talk about the income taxes paid disclosure. So let's just say that we have never done this before usually. So now you're going to have to come in and say, I had federal income tax liability of X dollars. I had federal income taxes paid of $0. And I decided to settle this liability through the purchase of federal income tax credits. And it's going to show right there in the disclosure exactly how much you purchased to get to your total income taxes paid. The general consensus is that federal income tax credits that were purchased from third parties should be included as a line separate from estimated tax payments. Remember that you're going to have to disaggregate your state income taxes paid as well. It's going to give specific jurisdictions if they meet the 5% threshold for disaggregation. So this is going to be a big change for a lot of companies, Marty. And those who are utilizing and employing effective cash management strategies to reduce their cash tax liability and effectively managing their effective tax rate through things like this, it's going to become very evident that they're doing a great job.
All right. Well, that was awesome. And it's the reason I wanted you to talk about this is I think it's a little bit extra in terms of some of the other presentations I've seen out there on credits. To talk about the accounting is something there. All right. So final polling question, then I'll wrap up the week. Would you like for a team member to reach out to you after this webinar from Cherry Becker? Yes. Energy tax credits. Yes. On transferability. Yes. Both energy and transferability. Maybe in the future, or no. Don't say no. We'll definitely, we can definitely talk, and we'd be happy to help. The whole point of this week was to talk about our approach at Cherry Becker for clients. Really, our preferred approach is to bring the heft of all of our strategic tax service lines, and you can even see the accounting side of it here too. But we talked a bit about what we'll look at from an R&D perspective, how 174 capitalization has been negatively impacting our taxpayers right now and causing taxable income to go up. That's why some of this appetite for credit purchase is out there, is due to the 174 capitalization. We talked about what we can offer as you're looking to potentially expand it and choose a new site. We talked about statutory state and local credits as well. Talked about our ability to work on cost segs to the extent you have buildings out there that you may want to accelerate some of the depreciation on. We also talked with Lewis Cole and Brian Dill earlier today on some of the aspects of transactions. I want to thank Laurel Tinsley from our strategic financing service group, Melinda Young, who also helped on many of these slides and some of the other presentations. And I really want to thank Will Billups and David Mohamadi, who are on with me here today. Again, I'm Marty Kerman. It's been a pleasure hosting these two sessions and working with my partners to host this entire endeavor from our strategic tax advisory services. We thank everybody for attending. And I don't know if that poll comes up at the end or not, but that was the last poll. And so that then ends pretty much on time. our discussion today. So please reach out to us based on your polling questions, and you want us to reach out to you. We're happy to do that too, but definitely utilize us as a resource here. We're more than happy in a variety of different disciplines to help you. So thank you.